Hi, and welcome to this morning's Global View Trend View video. We did not say early Trend View video because it is currently 9:15 a.m. on Wednesday, March 9th. And we purposely waited until this particularly, particularly later than usual time because was quite a bit that it was important to see in both the market activity and in the economic data that we wanted to review, and especially to the degree to which the Goldilocks mentality in the U.S. equities is still alive and well after serial, not just weak, but abysmal data Tuesday on Chinese trade, where exports and imports significantly collapsed, OECD composite leading indicators that were very negative, and the NFIB small business optimism that actually got back to a couple-year low. So it's all pretty bad, and that tied right into this morning's very much weaker than expected wholesale sales. And in fact, wholesale sales in the U.S. were off 1.3% in January. And yet, this market is still holding up, and that points up the Goldilocks tendency. And moving on to the short-term view of the actual price activity, here we have the S&P 500 that was actually up in pre-market trading all the way up at 1993 area. So in other words, just above yesterday's high of the mid-session bounce, which was also the high of the day after the gap lower in the morning, and yet couldn't quite get down to that bigger 1975 to 70 support range that has the tolerance down here at 1967. Now, who knows? It might still test that area later today on some type of pressure, but we're getting the feeling that it's going to be hard to pressure the market any further than we saw yesterday in front of the ECB tomorrow. Now, technically speaking, the higher resistances, the interim levels have been 1986 and 1995. But the market has been treating those as over-unders and been, working around them more so than treating them as significant levels. Next significant resistance is up at 2010 to 2020. And again, the next support is down at 1975 to 70. Now, it's interesting, this midline of this channel, and just to show you the importance of the channel, this is the overall channel up since that last sell-off low on the nasty post-Yellen testimony activity coming out of the 10th into the 11th of February, and that left that low at 1805, very near the previous significant low at 1804. We'll see that on the intermediate term charts. And then the market shot up once again in front of the ECB that ended up being a very positive indication as we went out following that. So what we then get is this gap back above the 1860 to 65 area. That's a big monthly chart level, as we've noted previous. And the rally continues. But when a market stays pinned up at the high side, it's hard to look back to the, especially in a broad channel, it's hard to look back at something grinding higher that it's going to get back down to the full lower support. So what we do in that case is construct the midline, which would have been in place even at this juncture based on these two highs, even though that line was reinforced further, was already in place when the market topped into 2007 area, going back into the 4th. And that would, of course, been last Friday. So here we are with the market backing off only to dipping below or into the midline. Now, this is important heading out into the ECB tomorrow, because even if it were to dip below this support, that's all the way up to about 1978 as we get out into tomorrow morning on the actual regular trading hours, you have that buffer, 75 to 70, even into 67. So even during the day tomorrow, let's go out in the mid-session, if this market were down into 75 to 70, it wouldn't be that far below that midline, and you have to allow for some tolerance below a line like that, as we saw on the nasty opening back on the 24th that once it couldn't stay down below the previous important area down around 92 to 90, it started to clean up again. If there's any disappointment with the ECB tomorrow, we might be in a similar condition of watching this market take pressure, and it'll be important to see if it holds that area into 1967 as a tolerance. If not, then you have to start thinking about going back at least down to 1960 or lower levels. And that pretty much does it for the short-term view of the S&P 500.